President Trump just unveiled his new tariff plan, and it is much stronger than what was originally anticipated. So you bet it is going to shake up the global economy, and it's probably going to shake up the stock market as well. The White House is calling this new tariff plan, quote, "Make America Wealthy Again." And President Trump has announced these reciprocal tariffs on 60 countries. And the way it's going to work is it is a baseline 10% tariff, but it can go a lot higher depending on how much these foreign countries are charging the United States. Let me read you directly what Trump said, and I'll break it down for you. President Trump said, quote, "We will charge them," these foreign countries, "approximately half of what they are and have been charging us." So what does that mean? Let's go directly to the White House statement. The White House says that China is charging a 67% tariff on goods from the United States. So the United States will place a 34% tariff on Chinese goods. Vietnam has been charging a 90% tariff on goods from the United States. So the United States will charge a 46% tariff on Vietnamese goods. Sri Lanka has been charging an 88% tariff on goods from the United States. So the United States will charge a 44% tariff back onto Sri Lanka. Now, here's the tricky part, and the part that has a little bit of uncertainty. This tariff amount that is being disclosed by the United States is based off of the tariff, but also currency manipulation and trade barriers. What does that exactly mean? Well, there's no clear answer. So based off of what the United States says are the trade barriers and currency manipulation, that's what the United States says is the tariffs that these countries are placing on us. So the United States is responding with very strong tariffs. And this is what President Trump says is going to now unleash, quote, "the golden age of America," which he says is going to bring back more jobs, more manufacturing, and bring in a new age of, quote, "domestic prosperity." Here's what President Trump said directly, quote, "We will supercharge our domestic industrial base. We will open foreign markets and break down foreign trade barriers, and ultimately, more production at home will mean stronger competition and lower prices for consumers." But here's the question. Are we going to see lower prices sooner or later? Because we've had a lot of differing opinions on this, where the Federal Reserve Bank says that these tariffs could bring in a period of, quote, "transitory inflation," essentially meaning if we are now charging these tariffs in foreign countries, that businesses that produce their products in foreign countries are going to have higher costs, which could then mean higher prices for consumers. Because remember, businesses, when they have to pay this additional tariff, can either shrink their profit margins or they can pass that cost down to their consumers, meaning raise their prices. We're going to see what ultimately happens in the coming days and weeks. And this is where Trump says that jobs and factories will come roaring back, and these reciprocal tariffs will be good because they will continue to bring this domestic industrial base back into the United States, which is not something we've had for a long time. And these tariffs are not waiting very long. For example, the United States has already, as of the time of this video being live, imposed a 25% tariff on foreign-made cars. So we will see the impacts very quickly, and we will see if any adjustments are made. Over the last couple of months, every time there's been a new announcement on tariffs, it started a new negotiation, and that will probably happen here as well. Now, I want to break down all of this and what this means, but I want to remind you that we talk about all this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. So if you'd like to stay up to date on news like this, you have to join Market Briefs. We have hundreds of thousands of investors that read it every morning, and it's completely free. Plus, when you join Market Briefs, you'll also get access to a free investing masterclass. So if you want to join Market Briefs, I have that link for you down in the description below. So I've already explained how tariffs are a tax. It's a tax paid for by generally the business that's importing goods from foreign countries. Now, the reason why I say that there could be negotiation on tariffs is that was the intent with this tariff plan. What I mean by that is when President Trump says that they're going to unleash these half reciprocal tariffs. In other words, China is charging 67% on United States goods, so the United States is going to charge 34% on Chinese goods, is so it incentivizes these foreign countries to lower their tariffs based off of what Trump is doing. So if China now says we're going to lower tariffs on the United States goods, then in theory, the United States would also
Makes
lower
sense to
their
me.
tariffs on Chinese goods. What's ultimately going to happen? Only time will tell. But we know in the short term is that these tariffs are going to shake up the markets. They're going to create a lot of panic. They're going to create a lot of anxiety. There could be some increase in the prices of things. Even President Trump has talked about that. And so what you want to understand now as an investor is how you can find the opportunity, because chances are we're going to see a lot of volatility in the markets, because this is the biggest tariff unleashment, if that's even a word, that we have seen in really our lifetimes. So all that is going to create uncertainty and volatility, and you want to be able to find the opportunity. But in order to find the opportunity, there's a few things you have to do. Number one, cut through the noise. There's a lot of political emotion. There's a lot of financial emotion out there. I want you to be able to put the noise aside. That way you can look for the opportunity. Number two, you need money to invest. That means you got to get your money right. We're going to see a lot of craziness in the markets in the short term and probably the medium term as well. And that craziness creates opportunities for the financially savvy. The average person is getting either angry or very excited. Wall Street is getting rich. So you pick. Do you want to get emotional? Do you want to get rich? If you want to get rich, you have to have money to invest in the first place. That means you cannot spend all of your money. That's the key. You're working a job, you have a business, you got to have money to invest, because that's what wealthy people do. They're focused on investing their money. The third thing is, where do you invest your money? And this is going to depend based off of you, your risk tolerance, and your investing strategy. For some of you, in fact, for most people, passive investing is a better way to go. Now listen, I can't tell you what to do because I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But the way passive investing works is you just invest your money into the American economy. And the way you do that is you find an ETF or index fund that gives you broad exposure. So I'll give you a couple hypotheticals. SPY. That is an ETF that gives you exposure to the S&P 500, the 500 largest companies in the stock market. If you buy that one ETF, you are owning a piece of the 500 largest companies in the stock market, and you don't have to worry about keeping up with those companies. An alternative would be VTI. VTI is an ETF that gives you exposure to the total stock market. So if you're investing in one of these types of ETFs, it doesn't matter what's going on with tariffs. It doesn't matter who's in the White House. It doesn't matter if the markets are going up and down. You follow a strategy called ABB. Always be buying. The only time you would change this is when you see a market downturn. That's the time for you to potentially buy more. And the way you win in this always be buying strategy is you set up a system. So every week or every 2 weeks or every month, you just keep buying a little bit more. Every time you get paid, you buy. When markets go down, well, now you can increase your buy to buy a little bit more aggressively, because when the stock market goes on sale, that can create a good buying opportunity.
Sales are good.
But for some of you, you might want to be a little bit more involved. You understand that it involves more risk, but also more potential return. This is where you want to look for more individualized opportunities. Now, instead of just investing in the markets, or maybe in addition to investing into the economy, you want to look for more niche opportunities. You want to look for what I like to call a market shift. You want to look for where the money is moving before everybody else. This is what Wall Street does. They want to know where's the money moving. So when you hear the news that all these tariffs are coming into the United States, you want to know, okay, if there are tariffs on China and Vietnam and Sri Lanka, where is the money going to move next? Is there going to be more manufacturing in the United States? If so, where is the investment opportunity? Could that be in construction companies that are building the manufacturing plants? Is it the logistics companies that can help transport goods from one manufacturing plant to the other? Is it in commodities like steel that needs to be used in these manufacturing plants? Where is that investment opportunity? You can start to see how it takes more work, it takes more time, it comes with more risk, but also more potential return. There's a lot of policy changes happening in the White House, which creates a lot of movement in the economy. Because as an active investor, you want to know where the economy is shifting, where the money is moving, because that's where the opportunity is. Now, yes, the government can influence where money is moving because the government is the largest spender in the economy, but they're not the only spender. There's a lot of other shifts happening as well. For example, artificial intelligence has created a shift. Now you might say, well, everybody knows about artificial intelligence, Jaspreet. Yeah, but there's a lot of new things that have to do with that as well. Artificial intelligence companies need data centers. Well, those data centers could also be a place that see a shift. Those data centers also need energy. Those companies that are providing energy to the data centers, that could be an opportunity as well. Those data centers need a way to stay cool. That could be another opportunity as well. And so now you're starting to think a little bit like an investor, because now you're looking for where is the money going to be moving over the next 5 or 10 years. And that can create an opportunity, assuming you can find a good shift and then a good company. But here's the risk. You could find a great shift. Let's say you like the idea of investing in an AI data center. But the first risk is AI goes away and those data centers go bankrupt. So the shift that you thought was there was wrong. You lose. The other risk is you invest in an AI data center company, the shift happens, you start to see a big investment in AI data centers over the next 5 years, but the company you invested in went bankrupt because they mishandled their cash. That was a risk with the company that you invested in. So not only do you have to be able to identify the shift, you have to be able to research the company. This is one of the things that I talk about in the masterclass. If you sign up for Market Briefs, you'll hear more about it. But the whole idea here is you're more involved. It's not for everybody. It takes more time, it takes more work, it takes more research. But if that's something you're interested in, when you see the craziness in the news, you want to ask the question, where is the money moving? That's what Wall Street does. But you can't even get to that question if you get so caught up in the emotion, you get so caught up in the panic, you get so caught up in the excitement. I want you to stay calm, cut through the noise, cut through all the political headlines, because guess what? Media companies are in the business of selling emotion. I know this because I own a media company. Briefs Media is in the financial media industry. Now it's a little bit different because our news is in one newsletter, so we don't need all the same sensationalism. We can be unbiased. But for traditional media companies, if they can get you excited or scared, they can get you to click, and that's how they get paid. And that's not a good thing when you are an investor, and that panic can get you to change where you put your money. So if you are actually investing your money, you have to learn to stay calm, cut through the noise, and find the opportunity, because a lot of things are going to be changing with tariffs. And a lot of tariffs are going to be changing over the next few days. I don't know how it's going to play out, but I'll be keeping you posted here. And we'll also be keeping you posted on Market Briefs. And with that, I will see you on YouTube tomorrow.
Good morning, everybody. Thank you for joining me for the aftermath of Liberation Day. So today's topic is one of the wildest markets that I've seen in a while. President Trump just dropped tariffs on 185 countries at the same time. Yes, you heard that right, 185 countries. This move could shape global trade, the U.S. economy, and your investment portfolio in a big way. Let me walk you through what happened, what it means, and what to expect going forward. Let's get into it. So I'm recording this the morning after, and this is what the market looks like. It is a sea of red, you guys. Here's a live chart. So the market ended at 4 o'clock right here at about 565, and this is the S&P 500. Look at what it's doing in after hours in the gray line down here. It's getting absolutely decimated. Hopefully things change by the time this video comes out. So let's get back to the facts. So earlier today, the Wall Street Journal reported that the United States would impose a 10% tariff on all countries, every single country. So markets shrugged it off. Futures actually moved up 2% if you guys were following the market yesterday, but that did not last long. At 4:26 p.m. Eastern Time, President Trump took the stage and picked up a poster. Yes, a literal poster, which we can see right here. And he started listing these tariff countries name by name. Check this clip out.
So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. So 67%, I think you can, for the most part, see it. Those with good eyes, with bad eyes. We didn't want to bring, it's very windy out here. We didn't want to bring out the big charts because it had no chance of standing. Fortunately, we came armed with a little smaller chart.
And by 4:42 p.m., just 16 minutes later, the S&P 500 futures had completely reversed, down 4% from their highs. That's a $2 trillion market cap swing in under 15 minutes. So you can see the Wall Street Journal report. The time is on the bottom. So this is military time. 16 means 4 o'clock. For you uncultured Americans, it's military time. I'm just kidding. So right here is 4 o'clock. Wall Street Journal reports 10% baseline tariff. Full list of tariffs is shown in addition to the 10% baseline, and look at where we're at by 6 o'clock right here. So insanity. So how do these tariffs work? You're probably wondering. So Trump explained that this isn't just a flat 10% tariff. Instead, he introduced something called reciprocal tariffs. So if we take a look at this chart, this is just one screenshot. Remember, there's 185 countries. These are just the ones I want to show you how it works. So on the left column, you can see the tariffs charged to the United States. I know it's kind of hard to see. I'll try and zoom in. Again, if you're not watching this on a TV, turn your device to the landscape mode, make the screen as big as possible. And then you can see in yellow, the USA discounted reciprocal tariffs on that country, okay? So here's how they work. If a country imposes a 20% tariff on U.S. goods, we'll respond with half a 10% tariff on their goods. So this sounds fair, right? So that's until you realize some countries already have sky-high tariffs in place. So China reportedly charges the U.S. 67%, so United States responds with 34%. You can see that right here, you guys. So European Union, roughly 40% with a 20% U.S. tariff. So this is not a flat 10% move. This is a calculated country-by-country tax on imports. So let's talk about how the market reacted to this. At the start of Trump's announcement, NASDAQ 100 futures were up 400 points. By the end, they were down 500 points. That's a 900-point swing in just minutes. We're now looking at the S&P 500 opening in correction territory. Investors are spooked, and tech stocks in particular are expected to get hammered. So if we look at this first screenshot that I opened the video with, look at technology over here, you guys. Minus 5.6%, minus 3.5%, minus 3.57%. I would take a look at the fundamentals of Google if you haven't. They've been getting pummeled over the last few months. This could be a good buying opportunity if you're interested in that business, even though you have to look at AI and stuff like that. But anyway, I digress. So anyway, everything's getting pummeled. Look at this huge dip. I've never seen anything this big of a swing in just minutes, you guys. This is something that is moving markets, and I've talked about this in my videos over the past few weeks. Okay, so what is the timeline of all this? So April 5th, 10% baseline tariffs on all countries are going to go live. So you can see that right here. This will take effect April 5th at 12:01 a.m. Eastern Standard Time. And then also on April 9th, the individualized reciprocal tariffs kick in. This will remain in place until Trump says the trade deficit threat is resolved. There's also some interesting exemptions. So you can see that there's no new tariffs on Canada or Mexico. Russia, they dodged the 25 to 50% tariff bullet. And then also, if you look at this screenshot right here, USMCA compliant goods, this is US-Mexico-Canada agreement goods, they will continue to see a 0% tariff, so they are exempt. Also, what I've been talking about the last few weeks, which this actually does sound like good news because I've been telling you to read the chip war, semiconductors, copper, pharmaceuticals, and lumber are also exempt. So this is a notable shift, especially since Trump previously said that pharma tariffs were coming soon. So take a look at this screenshot right here. You can see that some goods will not be subject to the reciprocal tariff. These include articles subject to blah, 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 steel, aluminum articles, and auto parts already subject to Section 232. And then here in the highlighted part, we have copper, pharmaceuticals, semiconductors, and lumber articles. All articles that may become subject to future Section 232 tariffs, bullion, and energy, and other certain minerals that are not available in the United States. So I think that's pretty interesting, and he is kind of, I don't know, I don't want to say backpedaling, but he talked about lumber, he talked about all this stuff before, and now it seems like it's exempt. So what does all this mean for the broader economy? So the U.S. average tariff rate will now rise above 10%, potentially higher than World War II. So if you look at the x-axis here, this is 1900, and it goes by 10 years, so 1910, 1920, 1930, 1940, Here's World War II right here, 1946, okay? So expect 150 basis point drag on GDP growth. So again, basis points is just fancy finance terms for 1.5%, 150 basis points. A basis point is 1/100th of a percent. So Trump projects $600 billion a year in revenue from the tariffs, but analysis estimates closer to $300 billion. This is a huge bet on boosting domestic manufacturing and revenue through trade taxes. So you can see in this chart right here, U.S. posts historic $300+ billion 2-month trade deficit heading into April 2nd, Liberation Day. So even though Trump promised the largest tax cuts in American history, the market didn't really recover from that. So check out this clip right here.
And now we're going to pass the largest tax cuts in American history, and that's where we're relying on Mike and John Thune. And we will not cut Social Security, Medicare, or Medicaid benefits.
So why didn't it recover? Well, because investors hate uncertainty, and this level of trade disruption creates massive ripple effects. So to top it off, we're coming off a record-setting $300 billion trade deficit, which I just showed you, and this is just over the past 2 months. So analysts now expect the largest one-week trade deficit in U.S. history. Oh, there's the sound effects, you guys. I did it. I hit the button. Yeah. So as producers rush ahead of these tariff deadlines, that's what's happening. Bruh. I'll end it with that. Bruh. So what do we do here? So here's the bottom line, in my opinion. These tariffs are massive. They're targeted and disruptive. That could be a good or a bad thing, depending on how you look at America's position geopolitically. 2, they will impact imports, producers, consumers, and investors. That's me and you watching and making this video. And then number 3, we're looking at major volatility ahead. So if you're an investor, this is the time to be sharp, disciplined, and unemotional. Stick to your strategy. Mine has been dollar cost averaging, okay? I assume that the chart will go up and to the right over a long period of time, so I invest the same amount at the same interval for many, many, many years now, since basically 2006. So you're going to manage risk and you're going to stay informed by watching this channel. So please share this video with at least 3 friends or family. And then if you want real-time reactions to this stuff on a private live stream with me once a week, check out Whiteboard Finance University. It's my private community down below. So this is Marco. As always, I hope you got value from this video. I'll see you in the next one. Gently click the subscribe button if you haven't. Gently click the bell for notifications. And gently share this video with 3 friends or family. And as always, have a prosperous day. Marco's got the best YouTube. All right, I'm not doing that again. All right, guys, peace. My Yeti is blue. My president is orange. My Yeti is blue. My president is orange. My Yeti is blue. My president is orange. My Yeti is blue. Bruh. My president is orange. My president is blue.
That was fun. Thank you, Marco.
On a day known as Liberation Day, President Donald Trump just dropped a bomb.
Carnage on Wall Street.
Markets falling, tumbling.
Stocks plunging. Down, down, down. The Nasdaq's getting crushed. Small caps are getting crushed.
This is a shock to the system.
It is ugly out there. Worse than worst case scenario.
Stocks are getting slashed and burned. $2.5 trillion vaporized.
It is estimated that the average American family will pay more than $5,000 out of their pocket to pay for these tariffs.
Economic tariffs on the entire world. The U.S. officially launched one of the most aggressive trade policies in modern history, putting a 10% tariff on all imports across the board. China got hit with 34%, Vietnam 46%. Even the European Union is facing a 20% tariff. Now the message is clear. America wants to bring production home, secure its supply chains, and assert its dominance. Now the people who support this say, this is needed to protect national security and rebuild American industries. But critics argue that we should get ready to pay higher prices, trade wars, and global economic fallout. But there might also be a twist ending to this story. Now these tariffs could be deflationary, and they could cause the US economy to slow down enough to force the Fed to lower interest rates and rescue the economy, which would allow the US to refinance its debt and send the markets to the moon. Now, all of this sounds kind of crazy. There's a lot of fear and confusion out there, and I want to help explain how this will reshape everything from your portfolio to the future of the global monetary system. So here's what's going on and how this will affect you. Let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the global reset. So we're back to tariffs again. So let me start by explaining what just happened, why it happened, the criticism for all of it, because there's a lot of good reasons to criticize it. And then I want to look at some of the theories of what could happen in the future. So first, here's what just happened. As of the day after the announcement of Liberation Day and all the tariffs were announced, the stock market was down about 10% from its peak, which is known as a correction. Now, this is interesting because just a couple of weeks ago, the story was the complete opposite. Markets were really excited and they were hoping for an economic soft landing, meaning people were hoping the economy would not go into a recession, but now it looks like we just might. And it's not just stocks. There's all kinds of stress in the system right now, including the credit markets, corporate bond spreads widening, currency fluctuations for trade-sensitive economies. For example, currencies of export-driven countries like the Mexican peso, the Canadian dollar, and the Chinese yuan weakened because they're expecting things to get a lot worse. That's because whatever the US does, it's going to be felt by the entire world. So right now, Wall Street's response is fear. There's layoff announcements that have started trickling in from companies hit by higher import costs. Business groups are spending a ton of money to get some kind of an exemption or to make Mr. Trump roll back the policy completely. But no one knows where all of this is going. And when the stock market doesn't know and there's uncertainty, it can't predict the future. So it becomes a roller coaster. So that's what's happening. But the next question is, why is it happening? And this all happened because of how extreme these tariffs are. And to be fair, the critics have a really strong argument against how these tariffs were created. So let me explain. The administration told us that these tariffs were reciprocal, meaning they mirrored what other countries charged the US for imports.
Makes sense to me.
Whatever they charge us, we charge them the same.
Reciprocal tariffs on countries throughout the world. Reciprocal. That means they do it to us and we do it to them.
They also claimed the tariffs were then cut by half because we're nice. But that's not true. These tariffs are actually a lot higher than what other countries charge the US. For example, China's average tariff on US goods isn't 67%. It's closer to between 6 to 10%. Vietnam faces 46%, but its tariffs on US goods are much lower. Tariffs on Australia are now 10%, but Australian tariffs on US goods is 0. They are not reciprocal. In fact, if you look at the world average before these tariffs, the US charged the world about 2.5%, and the world charged the US about 5 to 10%. So yes, it was unfair to the US. But these new tariffs are between 10 to 50%, which dwarf those rates. So the question is, why is the US going to charge the world so much more, and how did they pick these numbers? And it turns out someone figured out a formula that comes really close to how this was decided. The formula was based on a trade deficit with each country rather than directly matching the tariffs. So here's how it works. They took the trade deficit the US has with a country and divided it by the country's exports to the US, and then have the result for niceness. For example, the US trade deficit with China in 2024 was $294.4 billion, and imports from China were $439.9 billion. So step 1, trade deficit equals $295.4 billion. Step 2, $295.4 billion divided by $439.9 billion equals 67%. Step 3, 67% divided by 2 equals 33.5, so round up, which is how we got to 34%. A 34% tariff was applied to Chinese goods. Now, this formula was actually used for a lot of the countries listed, so let's look at another one. The US has a $17.9 billion trade deficit with Indonesia. Its exports to the US are $28 billion. So 17.9 divided by 28 equals 64%, which we are told is what Indonesia charges us. And because we're nice, we'll charge them half, 32%, half of 64. In reality, the number Indonesia charges the US is not 64% and never was. What it actually is about 8.1% on average. But it's certainly not 32%, and it's nowhere near 64%. Here's the rest of the countries if you want to pause and do the math yourself. But wait, it gets even worse. Because these numbers were purely based on goods, and the math completely ignored what are called the services section of an economy, which are things like tourism, education, financial services, And that's where the US actually has a trade surplus. In other words, we export more of that stuff than we import. And that should have been considered in the tariff calculation, but they were not. So what this means is that the US will now charge the world anywhere from 10 to 50% more for its products, and some countries even more on top of that for certain industries. So ultimately then, what does this all mean, and what's going to happen next? So most people will fall in one of two camps. The louder camp being, Trump is so dumb he doesn't understand economics. Oh. So that's one of them. But the second camp says, maybe there's more to this than meets the eye. So let's take a look at some history and what other people have said about this concept of charging other countries more money for our products. And you might be surprised to see who the critics are.
Look, I think the president's doing the right thing. China has been taking advantage of us for two decades. They're stealing our intellectual property, which means stealing our good-paying jobs.
How far does China have to go? How much more repression? How big a trade deficit and loss of jobs for the American worker? And how much more dangerous proliferation has to exist before members of this House of Representatives will say, I will not endorse the status quo. The lack of market access, the rip-off of our intellectual property, the transfer of technology, a country that is not willing to play by the rules in any respect in this trade relationship, you have a serious threat not only to our relationship, but to the industrialized world.
Further, what they have said is that we need to not worry about manufacturing in America, because what we should establish is a policy of unfettered free trade. We don't need tariffs. What we need is to allow corporate America the freedom to throw American workers out on the street, people who are making 15, 20, 25 bucks an hour, healthcare, pensions, throw them out on the street, because somehow, Madam President, we are going to create wealth in America and good-paying jobs in America as we shut down plants, we move to China, corporations there pay workers 20, 30 cents an hour, and we bring the product back into this country.
It's also proper for advanced economies like the United States to insist on reciprocity from nations like China that are no longer solely poor countries.
This is interesting.
To make sure that they're providing access to their markets and that they stop taking intellectual property and hacking our servers.
So imagine that. Tariffs can be beneficial as long as they are done strategically. Again, Mr. Trump has been saying this for almost 40 years.
I mean, you can respect somebody that's beating the hell out of you, but they are beating the hell out of this country. I don't know how your audience feels, but I think people are tired of seeing the United States ripped off. And I can't promise you everything, but I can tell you one thing, this country would make one hell of a lot of money from those people that for 25 years have taken advantage. It wouldn't be the way it's been, believe me.
But now here's where things get really interesting. There's another theory, which I think could be at play. Now, on the surface, tariffs are about fair trade by punishing importers, bringing back jobs, and protecting your own industries. But this theory has less to do with all of that and more to do with the Federal Reserve, interest rates, and the US national debt. Think about the timing, for example. The US economy has been facing high interest rates because of the Fed's fight against the pandemic's inflation. The government debt payments went way up because interest rates are now much higher than they were a couple years ago. In fact, US interest payments on debt are approaching $1 trillion a year. Money that just goes out the door to bondholders. Now, if you're a president who campaigned on debt reduction and economic growth, high interest rates stand in your way. Just think about how Donald Trump has built his wealth. His entire life, he invested into real estate, then borrowed against his real estate to buy more real estate. Some people call it the BRRRR strategy. Buy, remodel, rent, refinance, repeat. Buy, remodel, rent, refinance, repeat. And that can only be possible in a time when interest rates are low. He even said no one gets rich while interest rates are high. So enter tariffs. Tariffs hurt everybody. they raise costs, they scare markets, and they can stop spending and investment. That's a bad thing. Even Howard Lutnick said, the world putting tariffs against itself, of course it's bad.
When we're all equal and everything is free and fair, if you raise tariffs and they raise tariffs, isn't it bad for society? The answer is, of course it is.
But a slower economy can accomplish something. It might send the US into a temporary short recession so that it forces the Federal Reserve to cut interest rates to stimulate that growth, to revive the economy and to allow people to get rich again. And what else do lower interest rates do? They make it cheaper for the government to borrow and refinance its debt, of which this year there will be about $9 trillion of. Now all of this sounds almost Machiavellian, right? But it's a theory with a lot of data points suggesting that at least it could be possibly intentional. It's supported at least in part by one of the most legendary macro investors and economic historians of all time, Ray Dalio. You might know him as the founder of Bridgewater, which is one of the biggest hedge funds in the world, and the guy who literally wrote the book on global economic cycles, Principles for Dealing with the Changing World Order. And recently, he tweeted something that might help decode exactly what's going on. So Ray Dalio broke down tariffs like this. They're a special kind of tax, and when you understand their first and second order effects, it starts to make sense why all of this might be happening right now. And here's a really simple version of what he said. Tariffs raise revenue for the government and protect domestic industries. They're actually deflationary for the countries being tariffed and inflationary for the country that's imposing them. But if the economy slows down enough, the central bank, like the Fed, steps in with rate cuts, and that changes everything. In other words, tariffs can force the Fed's hand. Ray Dalio points out that these policies can actually reduce global economic efficiency, lower capital flows, and eventually lead to something called stagflation, which is bad for most of the world, but useful for the US if the Fed responds with easier monetary policy. He also said that tariffs can decrease our reliance on foreign production, boost domestic resilience, and help fix unsustainable trade and debt imbalances. So you take that idea and you combine it with $1 trillion in yearly US interest payments, and the fact that Mr. Trump's real estate background taught him the importance of refinancing during low interest rate environments, and suddenly all this starts to make a lot more sense. Slow the economy down, trigger a recession scare, force the Fed to cut, refinance the US debt, potentially reindustrialize the US, fix the trade imbalance, and make the trade more fair. Mr. Dalio even ended his post saying that the world's monetary and geopolitical systems are overdue for a reset, and that these kinds of abrupt, unconventional moves are exactly how it happens. He literally titled his new book, How Countries Go Broke. And while that might sound scary, it means that these kind of resets might actually be a survival tactic to reduce foreign dependency, rebuild domestic production, and make sure that the dollar stays strong as the world's reserve currency. But the real point I want to leave you with is that we might disagree on how to fix something. But as long as our goal is mutual, which is to fix something, then we should give each other the benefit of the doubt. And it's okay to be critical, which is why I explained that the tariff numbers made very little sense. It seems like they're confusing trade deficits with tariffs. But I also explained how this might also be part of a bigger strategy, maybe one that's more long-term. And maybe that's why Mr. Trump calls this Liberation Day, not just because it punishes other countries, but because it resets the system. It's like medicine or surgery, painful in the short term, but potentially healing in the long term. Ultimately though, no one knows, besides Mr. Trump, how long this pain might last. But if you want to go deeper with how these tariffs might affect your stock portfolios or crypto and how I'm investing, check out the last video somewhere up here, which explains all of that. But ultimately the lesson is, stay invested and you'll probably do just fine. In the meantime, I'd love to hear your thoughts. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye.
You can't really watch the stock market. There'll be a little disturbance. We're okay with that.
Lots of people selling off on the market.
You can see it right there on your screen.
Let the deal maker make his deals.
This is just the beginning.
What's up, Graham? It's Guys here, and all hell is officially broken loose. For those unaware, we have just witnessed the largest single-day stock market point drop ever in history, all because of a term that sends chills down every investor's spine.
Reciprocal tariffs.
That's right. Without exaggeration, tariffs are now the highest they have ever been since the early 1800s. And beginning today, they are single-handedly changing the entire landscape of our economy, from the value of the US dollar, potential trade wars, and a worldwide fallout. In fact, the situation has gotten so bad that some headlines are drawing eerily similar comparisons to that of the 1929 Great Depression. So with nearly everything significantly falling, with the exception of Warren Buffett's cash pile, let's discuss exactly what's happening, what this means for you, the impact this is about to have on pretty much everything, and then finally, how you could use this information to profit. Because I'm not gonna lie, this might wind up being a very difficult next few months, and the more you could understand exactly what to expect and how to prepare, the better. But before we start, as usual, if you appreciate the last-minute breaking news videos like this, it would mean the world to me if you slapped a tariff on the like button and subscribed if you haven't done that already. I know it's annoying and I get tired of asking for it, but it does objectively help out the channel tremendously.
It does help.
Thank you for doing that.
It's always
I'll do my
nice
best to read or reply to as many
to like and
comments as I
subscribe.
can. So thanks so much, and also big thank you to Surfshark VPN for sponsoring this video, but more on that later. Alright, so I've said this before, but I'm gonna say it again because it's important. In order to understand the impact this is about to have on our entire economy, we need to answer the question, what is a tariff? Even though there's plenty of technical definitions out there, just think of this like an additional tax that's collected anytime you import goods from one country to another. The theory is that if imported goods become more expensive, it'll encourage people to buy and manufacture locally. And if they don't do that, then at least the government gets to collect a little more revenue in the process. And if that sounds confusing, here's an example. Let's just say that China makes and imports a vehicle into the United States for $25,000. Well, this competes with American-made cars that cost $50,000 to make. So as a result, American-made products are seen as more expensive and less desirable, and demand for Chinese cars increases. However, in an effort to level the playing field, a 100% tariff is placed on cars from China, and all of a sudden, both items now cost the exact same when sold in the US, thereby increasing revenues for the government, driving more demand for locally made goods, and making American products slightly more appealing. Now, in terms of who pays this tariff, despite what you might think, it's not paid for by the other country, but instead by the person or the company who imports that item to the United States. So if Ford brings in parts from out of the country while making their F-150, Ford is the company responsible for paying the additional tax, and not the country who makes the item. And this could result in nearly every single item that you use on an everyday basis going up significantly in price. Like, without exaggeration, you could apply this towards any import, like clothing, batteries, housing materials, cars, and electronics, and all of a sudden, this additional cost has to come from somewhere. So why is this likely to result in a trade war? Well, like I said, the thought process is that tariffs can be beneficial in four main ways. First, they protect US companies from foreign competition. In this case, if imported goods become more expensive, then local companies have a chance to compete with their own products. This leads to, number two, increased job growth. When local companies are able to compete, they're likely to hire more workers and sustain a higher employment rate. That leads to, number three, higher government revenue. The more jobs hired locally, the more revenue the government can collect in taxes. And even if more jobs aren't created, the government is still collecting additional revenue coming in from the tariffs, which could then result in, number four, favorable trade negotiations. Perhaps other countries don't want tariffs on their products because that's going to hurt their own economy, so they negotiate to buy more American-made products, resulting in a fair global trade around the entire world. Although in terms of how we came up with these tariffs, here's where things get interesting. For the last 50 years, the United States has been in what's called a trade deficit, where we buy more from other countries than they buy from us. Why? Well, frankly, other countries are able to make goods and services for a lot cheaper than we can manufacture here, and this could result in the detriment of our own workforce in the United States who can't keep up, as well as the value of the US dollar, which constantly gets spent overseas. So in a way, tariffs were put in place on Liberation Day to level the playing field. Now, in terms of how these tariffs were calculated, It's a bit confusing and there doesn't seem to be a direct science to this, but it does seem to be pegged to the amount that other countries impose on the United States. However, there is a very big risk to this strategy because as we're starting to see, other countries are beginning to fight back with reciprocal tariffs. In this case, China went on record to urge the United States to immediately lift tariffs, otherwise they vow retaliation. Canada said that if we tariff them, they're going to tariff us, which is going to result in us tariffing them even more, and them tariffing us even more. Europe is preparing for countermeasures to take place, and we're basically finding ourselves in a very volatile, scary game of chicken to see which company blinks first and who gives in to the United States' demands. After all, realistically, tariffs just result in, number one, higher prices for everyone, especially because most of the companies just pass on the additional cost to the consumer without any guarantee of benefiting the United States. Second, a trade war becomes more and more likely, resulting in a stalemate that just hurts everybody. And that leads to 3, less economic growth as people cut back and buy less, which is what we're starting to see. As it stands now, economic uncertainty just spiked to levels never seen before on the index. US companies cut 275,000 jobs in March, marking the highest number of layoffs since May of 2020, and April 3rd was the worst day in the stock market since June of 2020. This is partially why Trump said that he's open to trade negotiations and is urging other countries to lower their tariffs on us before shit hits the fan. Although in terms of what this means for the future, you're going to want to hear this. Although before we go into that, I'm going to be honest, it's truly astonishing the lengths people go through to... Now let's get back to the video. Alright, so in terms of where we stand, let's talk about tariffs gone wrong. See, here's the thing. Tariffs aren't this new concept. They've been around for hundreds of years. They are used on a regular basis, and in specific situations, they make very little difference to the economy whatsoever. But when implemented on a broad scale, as history shows us, things could get very bad very quickly. And when it comes to this, let's take a look at the early 1800s, because believe it or not, they had similar tariffs as we have today. Back then, tariffs were implemented to protect US industrial products against competition from foreign imports, and tariffs were increased all the way to 49%. In this case, US manufacturing certainly benefited, but the agriculture industry did not. Over time, this resulted in the reduction of tariffs when individual states argued that they were unconstitutional. And all of this laid the groundwork for the Civil War. After that, we had another round of tariffs in 1930 known as the Smoot-Hawley Tariff Act. At this point, the United States was in a very tough position of being in the middle of the Great Depression, with unemployment being very high and businesses were struggling. So as a way to help boost the economy, tariffs were placed on foreign goods to make American businesses stronger and prevent foreign competition from ruining the lives of everyday Americans. But instead, the opposite happened. Instead of American products booming, other countries got upset and raised their taxes on US products. That caused a lot of local companies to sell less, they scaled back, and many of them went under. On top of that, world trade diminished because many other countries refused to do business with anyone outside of their own border, making the global economy a lot worse off. This meant that people wound up paying significantly more for the exact same items than they did before, and 100 years later, the Smoot-Hawley Act was actually credited as making the Great Depression worse. Yet here we are in 2025 implementing tariffs once again higher than we saw during the Great Depression and at levels we've not last seen since 1828. Although here's where things get a bit confusing. According to the Market Sentiment blog, who I'm a big fan of, by the way, and I'll link to down below in the description, some of the tariffs implemented don't make any strategic sense, and they gave the example of Taiwan. In 2024, the US imported $116 billion worth of goods and exported $42.3 billion, creating, on paper, a rather significant trade deficit. But once you begin to zoom out, you'll realize that the United States gave Taiwan $1.5 billion between 1951 and 1965 to build out their economy. We helped them become a leading manufacturer of semiconductor chips that US companies take advantage of. So it's not out of the ordinary that we buy more from them than they buy from us, especially when they have 1/10 the population and 1/3 of the wealth. Or here's another example. Malaysia. Their main export is palm oil, something that we don't even produce, and they have no competition whatsoever with the United States. Yet here we are with a tariff against them. So historically, why haven't tariffs worked? Look, I really want to give full credit to the Market Sentiment blog for this example because they really said it best. Think of it like this. Mexico makes a hammer
Here
for
we go.
$2 and sells it in the US for $4. If you made the same hammer in the US, it'll cost $6. So no hammers are made. In response to that, the US puts a 300% tariff on hammers, so Mexican hammers now cost $8. This allows the United States to compete and sell its own hammer for $8, thereby making a profit. But now, the US consumer pays $8 for a hammer instead of $4. Now sure, people could certainly argue that in that case, United States companies are now able to make a $2 profit and hire domestic labor that otherwise wouldn't have existed. But the extra cost has to come from somewhere, and usually that's at the expense of everyday items costing more and the market falling to compensate. To make matters worse, so far the money collected from tariffs has only helped offset a very, very small amount of our national debt. For example, in 2022, they generated $80 billion for the US government, which was just 2% of all US revenue, enough to keep the government going for just 15 days. That's it. It's also said that personal income taxes in the US raised more than 27 times as much revenue as tariffs in 2021. This pretty much suggests that it'll be impossible to run the US government on tariffs alone. In fact, it said that a tariff hike of 69.9% in the level of imports for 2023 seems like it could fully replace individual income tax revenues. But that's not considering any of the fallout of mass layoffs, reduced spending, and less investment, which feasibly makes it a losing proposition no matter how you look at it. Separate from that, we also just have to acknowledge that other countries sometimes just have the ability to produce items better and more efficiently than we can in the United States. It's why Mexico exports avocados thanks to their soil and climate than, let's say, Finland, where it's too cold. The same applies to coffee beans. There's a reason why the majority of coffee is produced throughout the equator versus Antarctica. It's for these reasons that for a variety of exports, it makes sense to create what you have an abundance for. And unfortunately, a trade war really discourages that. That's why I think tariffs can be useful in limited niche situations for protecting certain US products and services, but on a broad scale, everything historically suggests that they're a bad idea, they wind up raising prices and having a negative impact on all income groups, and it's best to just allow the market to do its thing. After all, most likely, this is going to have the biggest impact on the lowest income bracket, costing them 5.5% of their disposable income. However, even with all of that said, there is something to be argued about using tariffs as a negotiation tactic for more favorable trade deals around the entire world, knowing that other countries have more to lose than we do. Sure, I see many people comparing this to bullying smaller countries who don't have the size or wealth to compete with us, but I would like to think that this is all part of a plan to negotiate more favorable terms. And as long as this doesn't go on for too long, then it might be effective. But then again, if the rest of the world bands together and refuses to back down, this could get very ugly very quickly. This is why the S&P 500 dropped almost 5% in a single day. It's why people were panicking at the thought that an entire year's investments growth are gone in a matter of 8 hours. And in terms of my thoughts on this and what you could do about it, here's what I think. When it comes to tariffs, it's largely outside of your control. There's not much you could do about it, and there's no sense wasting mental energy thinking about what might or might not happen.
Don't carry the weight.
Instead, you get a much higher ROI simply by living below your means, making sure you keep a consistent income, and having a long-term approach to investing. From an investment standpoint, the stock market's best days often happen in a bear market, when prices are down the most, and this usually happens after the worst days. This is why I'm not trying to time the markets, but instead I'm using it as an opportunity to buy in a little bit cheaper, because as long as I'm not planning to sell anything that I have for another 10 or 20 years, anything that happens in between now and then really makes no difference whatsoever. Honestly, as much as it sucks to be down a ton of money, it's just par for the course. Like, this is normal investing. When you look back over the last few decades, this happens on a consistent basis. And that's why, for me, I'm not really panicking. Yes, I know all of this is boringly simple, but study after study shows that if you miss the best 10 days in the market, your return drops substantially.
This is always
fascinating. This is the single reason why the average person is such a horrible investor, underperforming just about everything. Like, even a dead person has much higher returns because they don't get emotional about their investments, since they're dead. Anyway, that's what I'm doing. I bought more yesterday, I bought more today, and I'll continue no matter what, smashing the like button and subscribing if you haven't done that already. And if there's anything I missed, by the way, or anything you want to add, comment down below, and I will do my best to read and reply to as many comments as I can. Oh, and lastly, some colleagues of mine are working on a free budgeting software that's meant to replace the likes of Mint.com. So if that sounds interesting to you and you want to be a beta user of it, I'll link to it down below in the description so that when it launches, you can be one of the first people to try it out and share your feedback. So that's it. Thank you so much, and until next time.
All right.